state of the market right now and kind of all the talk around the economy. It's good to have some new folks in your corner. Okay, so what I'm going to do now is hand off the floor to Pete. So Pete, take it away, man.
All right, thanks, Megan. Today we're going to talk about entity formation and structure and how different entities can save you on your tax. So we'll just kind of speak high level, and then after that, the little presentation, if you have specific questions, we can kind of get more into the weeds there. So the first entity that most people have when they're starting out, whether it's a self-employed business, is they do their 1040 Schedule C. So they'll file on their personal income tax return, the 1040 Schedule C. So they'll have income that flows from the Schedule C onto their personal return, and then they'll pay tax on that. The problem with doing the Schedule C as a sole proprietor or as an LLC taxed as a sole proprietor is all that income that's net profit, you end up paying employment tax on. So you end up paying 15.3% just in employment tax. So if you made $100,000, you're paying $15,300 to the government for the employment tax, Social Security, Medicare, Medicaid. You do get a little tax break on the end of it, but just for this example, that 15.3% goes straight out of your pocket and into the government's. So depending on how much money you're making on your sole proprietor or LLC, staying in that can be beneficial because it's kind of easier and cleaner to file taxes. But once you hit over certain income thresholds, you'd really want to look into forming that LLC to be then taxed as an S Corp. So by having it taxed as an S Corp, you can actually pay yourself a reasonable W-2 wage. So back to that $100,000 example, let's say you go online, look at Indeed, you find a similar job posting for what you're currently doing, and it's about $50,000. You can pay yourself a W-2 wage of $50,000. So that $50,000, you're going to pay that 15.3% on, half from the company S Corp, half from yourself as a W-2 wage. So that would save you about $7,600, $650, because you're only paying that 15% on $50,000. That other $50,000 to get you to that $100,000 mark, that's paid out as a distribution as for an S Corp. So that distribution, since it's not really a wage or an earning, it's more kind of a bonus as a distribution for the profit in the company. That avoids that whole 15.3% employment tax. So by changing the tax status of your sole proprietorship, once you get over about that $50,000 threshold, you can save, depending on the income of the company. In our example, you'd be saving $7,650 in taxable income by just keeping everything the same, but by electing S Corp status for your LLC. As an S Corp, once you get to a certain profitable amount, or your business starts, let's just say instead of making 100,000, it's making 600,000 to $1 million. At that point, it actually might be good at creating a C corporation. So the reason you want to look at a C corporation is it has a federal tax rate of 21%. So if you have $1 million in an S Corp, you're probably going to be in the higher tax bracket of 37% once you pass that 530 some thousand mark. And you'll be paying like 37% of all your income then. Granted, once you do the tax brackets, it might be a tad lower, but theoretically, if you are making $1 million in your S Corp, you're going to be in the 37% tax bracket. But if you go to a C Corp and have a C Corp classification, you're only going to be paying 21%, which then will kind of reduce your tax liability by 16%. Now, when you do put it in a C Corp, the remaining money that the corporation made, it is not in your bank account. It is in the company's bank account, and it stays there as retained earnings, but the company can reinvest it and grow and keep making money. Or you can pay a qualified dividend out of the S Corp into your own personal account a year later, a couple of years later, or just depending when you want to make that withdrawal. And most of those dividends will be taxed at 15%. But if you time it to, let's say, you retire, you have no income at all for the year, you're not taking any Social Security, you don't have a pension, you don't have any withdrawals from your 401k or other investments. If you're married, the first $83,350 in qualified dividends, you can pay 0 tax on. So you can, in essence, just take that as a qualified dividend out of the C Corp tax-free. If you have ordinary income of, let's say, $50,000, and that's what you're making, you can then take $33,350 out of the C Corp, pay 0% capital gain tax on. So really, by putting up and opening a C Corp, all you're doing is kind of deferring your taxes. And then you want to do strategically withdraw the retained earnings when you have very low income, so you can pull more of it out at a lower capital gains rate, and then thus at a lower tax rate. So that's kind of the big 3 entities, main entities that people use. Again, it just really depends kind of what state or what stage in your business you're in. So one really high level, I guess I want everyone to take from it is when you're starting to, whether you're in the process of becoming a real estate investor or starting your own business or already established, you really want to look at your entity, because that entity structure can save you thousands of dollars in taxes. And especially with the current economic environment, and who knows if it'll get better or worse over time, the more you can just save in taxes, the better you'll be off financially. So it's kind of worth doing a second look. And if you need us to do it, just give me a email or contact ROS, and we can help set up like a tax planning and strategy session to look to make sure your entities are correct. What you're referring to, the one, what are the benefits of an S Corp over the LLC? Yeah. So my personal opinion is it depends on your dollar amount. If you're under 40 to 50,000 in income, probably staying as an LLC might be worth it, because you don't have the administrative headache of having someone do a W-2 for you through Gusto or ADP or your other type of bookkeeper. You don't have to have those annual meetings, and the cost benefit of actually doing an S Corp conversion and paying the taxes, paying the fees, paying the unemployment, it may not benefit the savings you would get if you're about under that $50,000 to $40,000 threshold. Once you hit that $40,000 to $50,000 threshold and have income above it of at least 10 to 12,000, let's say, that's when I'd start looking at doing the S Corp, because then all these excess costs of having an S Corp are still under what the tax benefit is. So at that point, your cost benefit's positive because you're getting more savings in taxes than you are having to pay out for having that S Corp. So that usually hits at that $40,000 to $50,000 rate. As well as the S Corp, you can do the Augusta rule, which can save you, depending where you live, a couple grand to quite a bit of money, actually. So yeah, if you're all passive income, I'd stick with the LLC, do your series LLC, and I don't even do the S Corp. The S Corp's more for those in the active income arena.
Yeah.
So yeah, good catch. Thanks, Chris. Depending on your strategy, I mean, a lot of the books out there is take your active, buy a passive income, quit your day job, get that financial freedom number from your passive income, and just stay passive income, and then live off that. So that's kind of the general theme of a lot of the books. But, if you want to get a little more entrepreneurial, then you're back to active. So annually look at your umbrella insurance policy, make sure it covers your assets. Especially depending on what states, some are a little more litigious or lenient on giving higher payouts, to where, that's something you want to look at every year, especially if you don't have it set up in that entity of its own LLC. Like you said, it might be cheaper just to pay more for an umbrella policy, so you're covered that way. One of the questions we had, what is the advantage of holding securities in the DST that don't pose any liability threats? Really just by putting
You drive on streets?
the securities in the DST is if you or your child or spouse end up getting in a wreck, your car insurance may not cover the cost of the medical, or you may get sued. And if your 401k and all that's in your personal name, they could theoretically maybe go after that or any of the profits after that. Well, if it's in a DST, the DST is the owner of it. They can't sue your, pretty much your assets. They can't get to your stocks that way.
Yeah, that's something we can do. I mean, the DST, just kind of give everybody else a little primer. You can have separate partners per child series. There's ways to do it. Now, that has some tax implications and some organizational admin type stuff we need to consider. But if you have outside partners, I wouldn't automatically discount the DST as an option. The ones that share common ownership. So any child series that has the exact same ownership structure as the parent DST flows up through. But if you've got a child series where you have, partner C comes in and is not involved in the parent or any other child series, we would get that new child series, its own EIN. It would have a bank account because there's outside partners, and it's a different tax reporting. But it can be done. That way you still have it under the parent DST, but it's kind of a side gig.
All right, looking at the questions, the only other one I can't really see that I don't think we've talked too much on was LLC tax as an S Corp versus actually converting to an LLC. So from a tax standpoint, there's really not a difference between an LLC tax as an S Corp and an entity created right off as an S Corp. So on the administrative and legal side, I think Chris spoke on it earlier. You do have to have that annual meeting on the S Corp setup, and there's a few more documents and articles or some sort of formation that I think is a little more on the S Corp side. But from a tax side, there's not really a difference. Yeah, I would say on the starting out business, I'd want the asset protection stuff done soon or earlier than the tax. I mean, to me, that's more important. Tax stuff, you may overpay a little bit for a year or two, but we can always adjust that. We can always elect the S Corp status as long as it's in the first 3 months of the current year, or for the following year, we can get it elected. So yes. I would agree, focus on making a profit to where your cash flow is positive. And then I'd look at getting the proper asset protection set up. And then once that's set up and your profits are growing and growing, then step into like the tax planning and strategy session, where we can then kind of map out, here, once you hit this metric or this financial goal, switch over to an S Corp or stay as a schedule or stay as an LLC and just keep it passive. But if you want to start branching out into other businesses, you may want to look at this entity, but still keep this entity as it is. So that's where I would agree. Once you get a certain threshold, or you already know you're doing that, then pay the upfront costs. But
I think a good rule of thumb is when you start incurring liability, it's time to get that asset protection structure. And what we've seen is, typically that coincides when you start making a little money and can start investing in it. When you first get going and you're getting your operations in place and you're identifying properties and things like that, you're not in a litigious state. That's not going to be something that's going to probably come up for you. But as soon as you start getting tenants and contractors and things around where you've probably got some capital to flow out to it, it's probably time to start getting that asset protection in place. And I think Pete's right. Start with something that is simple, scalable, and then when you need to move to that S Corp, you've got the funds for that kind of thing. That's going to be a little later down the road. And so, Liz just dropped in the chat for us our asset protection quiz link. And I think that's a good place to get started because it kind of walks you through of what's your current structure, and we can get you resources that'll lead you then to where really should you be starting. And then once you kind of get that frame of mind of, here's what you want to do or what you think you may want to do, here's the structures you may need, get a little time on your belt, let's get you with Pete, get the taxes set up. But I do think there's a natural flow from business inception idea to the point where you need to go taxes, and asset protection typically falls in the middle of that.
Yeah, thanks, Megan. That's a good point. One question is a qualified dividend. So a qualified dividend is usually, as a practical matter, most stock dividends are considered qualified. Now, there are some dividends that hit ordinary income, but from a US IRS standpoint, most dividends are qualified. So if you haven't retained earnings for multiple years, it's probably going to qualify it will be a qualified dividend, and that's where you get the capital tax rate on it. There's not a real specific line on it, but there is just most U.S. dividends are qualified. So on the C Corp example I gave earlier, you would just keep banking profits, and instead of distributing them like you have to in an S Corp, you just keep building the retained earnings. Those are kept over time, which then that would qualify as the capital gain. But REITs, I think, are more of I think those are ordinary because they're an active kind of business. You're not getting a dividend from a Apple, Microsoft, power companies where the retained earnings are built over the life of the corporation. Great. So what it looks like, I have one task is to talk to some of my friends in banking to see if getting a loan through an S Corp or just keeping it through your personal name is easier. I'm thinking it's going to be the same answer, but I'll post that in Discord once I get feedback from them. So anybody else have a question or?
All right, guys. Well, thanks for another great meeting. Thanks, Pete, for joining us today. Yep. So like Pete, take an eye on the Discord. Pete's going to be posting some stuff there. Like we mentioned, the quiz is a great resource to get plugged in for our team as well. So you've got the resources we can send to you. We know how to tailor them to exactly your circumstances, but hope everybody has a great week. And we'll see you guys next Wednesday.
If I can make just a quick comment. Hey, Megan and Pete, thank you so much for taking time out of your schedule to do these things. I so appreciate it. I know a lot of other people do too. So, thank you again for continuing to do these.
Yeah. Thanks, Chris. I appreciate that. I won't speak for Pete, but I love doing them. I think they're a lot of fun and I get a lot of value out of them as well. So thank you guys for showing up. That, that makes a big part of it.
You got it.
No, you're welcome. It's always fun to learn something new and get random questions that make me think. So I enjoy it.
Me too.
All right. See you guys.
Thanks, guys.
Bye. Thank you.
Bye, everyone.